Supply-side economics. Supply-side economics focuses on boosting economic growth by increasing the supply of goods and services. The idea is that if businesses and individuals have more money, they will invest and produce more, leading to overall economic growth. Key components of supply-side economics include tax cuts, reducing taxes for businesses and individuals. The theory suggests that lower taxes increase disposable income and investment capital, leading to economic growth. Deregulation, reducing government regulations on businesses. The belief is that less regulation lowers costs for businesses, encouraging innovation and expansion. Supporters of supply-side economics argue that these policies lead to job creation, increased investment, and higher economic growth. Critics, however, argue that it disproportionately benefits the wealthy and can lead to increased income inequality and budget deficits due to reduced government revenue. Keynesianism. Keynesian economics, named after the British economist John Maynard Keynes, focused on managing demand to achieve economic stability and growth. Keynesianism became particularly influential during the Great Depression when Keynes argued that government intervention was necessary to lift economies out of downturns. Key components of Keynesianism include government spending, increasing government spending during economic downturns to stimulate demand. This can involve public works projects, social programs, and other forms of direct spending. Fiscal policy, using government budgets to influence economic conditions. This can include adjusting tax rates and public spending to manage economic cycles. Monetary policy, managing the money supply and interest rates through central banks to control inflation and stabilize the economy. Supporters of Keynesianism argue that active government intervention can prevent or mitigate economic recessions and promote full employment. Critics, however, argue that it can lead to excessive government debt, inflation, and inefficiencies due to over-reliance on government intervention. Key differences: focus. Supply-side economics focuses on increasing supply by making it easier for businesses to produce goods and services. Keynesianism focuses on managing demand by using government policies to influence spending and investment. Government role. Supply-side economics advocates for a minimal role of government in the economy, emphasizing tax cuts and deregulation. Keynesianism supports an active role for government, particularly during economic downturns, through increased spending and fiscal policies. Policy tools. Supply-side economics relies on tax cuts, deregulation, and free market principles. Keynesianism uses government spending, fiscal policies, and monetary policies to manage economic cycles. Impact on conservative economic policy. Conservative economic policy has been heavily influenced by supply-side economics, particularly in the United States. During the Reagan administration in the 1980s, supply-side principles were at the forefront, leading to significant tax cuts and deregulation. The idea was that by reducing the tax burden and regulatory constraints, businesses would invest more, create jobs, and drive economic growth. Keynesian principles, however, have also played a role in conservative economic policy, particularly during times of crisis. For example, during the 2008 financial crisis, even conservative governments implemented Keynesian-style stimulus packages to stabilize the economy. Reaganomics, 1980s. President Ronald Reagan's economic policies were rooted in supply-side economics. His administration implemented significant tax cuts, deregulated many industries, and reduced government spending on social programs. Supporters argue that these policies led to a period of economic growth and job creation, while critics highlight the increased income inequality and budget deficits that followed. 2008 financial crisis. During the global financial crisis, many governments, including conservative ones, turned to Keynesian measures to stabilize their economies. This included significant government spending on stimulus packages, bailouts for key industries, and efforts to stabilize the financial system through monetary policy. COVID-19 pandemic, 2020. The economic response to the COVID-19 pandemic saw a mix of supply-side and Keynesian measures. Many countries implemented large-scale stimulus packages to support businesses and individuals, alongside efforts to reduce regulatory burdens to facilitate quicker recovery.